Well, thank you for joining Don Gelling and that guy, Gino Franti, on the National Real Estate Cafe, where we get you all the information to know what's really happening in the real estate and financial markets on a daily basis. And you can get these sent right to your phone by texting NREC to the number 58885.
All right, today we're going to wear our Mythbusters hat, and we're going to talk about one of the most common misconceptions that we receive as loan officers. We get this all the time. So let's pull up that slide and show you.
That's right. All the time you guys are like, don't run my credit, don't run my credit. But you want us to give you accurate numbers. We need to run your credit. So you're panicky that if you run my credit, again, meaning you're shopping lenders, which you are allowed to do, that is going to crush your credit. Guess what? It barely even touches it.
All right, so here's why this myth exists. The problem is, let's say you ran your credit today at one lender, and then you run it with us 2 weeks later, and it dropped significantly. Well, the number one factor that affects your credit is how much you owe on your credit cards. So let's say that different credit cards have reported to the agencies that you owe more money. Now your FICO score dropped. And that's how this myth comes to be, because nobody likes to watch their FICO score drop. So if you're going to let somebody else run your credit and they've already had a subsequent pull, think to yourself, what did my bills say last month when I received my credit card bills? That's the number one factor, is the relationship of debt to total debt limit that you have. So if you're looking to get a great FICO score, before you let someone pull your credit, pay down all your credit cards and let that bill come back very low, and then go run your credit.
Yeah, let's roll back to the screen one more time here. So right here you can see that 65, that's right, 65% of your score is linked to two elements. Your payment history, of course, are you paying your bills on time? And credit utilization that Gino just went over, meaning the percentage of how much credit you're using versus what's available. If you're at over 30%, it affects you quite a bit. If you hit 50%, it affects you a lot. Over 70%, you might as well be tapped almost. That's the way the creditors look at it, is that if you're over 70%, they feel you're running out of money. Even though you may have 6 other credit cards that have no balances, but you have one because it's the lowest interest rate, it affects you. So be careful. You might want to actually spread that debt around to stay below 50% or 30%. That actually gives you a better FICO score.
Yeah, so true life story is we had a couple come in just a couple of days ago, and a $72 late on SoCal Gas, okay, didn't pay their gas bill, $72 collection, dropped their score nearly 100 points. And it's because it was very recent collection, just 2 months ago. And that had a $350 a month impact on their qualifying.
Ow.
They still qualify, they'll still be able to buy, but now $350 more a month because they didn't make a $72 payment on time. So as Don said, make your payments on time, keep your credit card balances low, and that's the secret to a great FICO.
All right, you heard it right here on the National Real Estate Cafe. Again, you get these sent right to your phone by texting NREC to the number 58885. Share with your friends or check us out at donandgino.com.